All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Eric Dhall.
Hey, hey, hey.
It's 10:02 Pacific time here on September 20th. Eric, it's the last weekend to celebrate because officially the end of summer is on Saturday.
I can't say I'm sad to see it go.
Well, I guess it's been a little chilly out, and we got a little drizzle this week. So I guess that's what we're gonna have in store for us for the fall here. But it was a kind of a busy week here from the market's perspective. Obviously, we're gonna talk about the Fed today. Maybe a little bit different reaction from the markets than people were expecting, given the Fed cut 50 basis points. Both hop right into the where are we for the week, and S&P up 1.4% as of time recording for the week. Up just a little over 1% on a month to date. We only have one more full week next week in September before we end the month and the quarter. And we're up, looks like 4.8% on the quarter and 20.8% on a year-to-date basis. So I think we were at the all-time highs earlier this week. Kind of gave a little bit of the back over the past couple days, but all in all, a good week for the stock market. Looks like you had three negative sectors for the week: staples, healthcare, and real estate, all negative. The big winner was communication services up 2.5%, discretionary up 2.2, the big winner, I missed energy up 3.7%. I'm not used to seeing that as one of the big winners there. Looking at the kind of the overall, Russell 1000 was up 1.5, Russell 2000 up 2.6, and then growth and value, growth was up 1.8%, value up 1.3. So a little bit of a divergence there, kind of more of the same story that we've had for most of this year, coming through there from the stock market. Also, when we go, let's kind of shift over to bonds here. We did see a pretty good curve steepening, at least from like the 2s10s perspective. The 10-year was up 7 basis points on the week, and the 2-year down 1 basis point. So now we're really in the looking at it right now, we are 15 basis points in terms of your 2s10 spread. So we're significantly into that de-inversion of the Treasury curve. No more of this on the border. Will it or won't it re-invert? It's pretty significantly steep now. So that's as Sam and I talked about last week. That is, or 2 weeks ago. That is certainly a recession signal. What did that or I guess let's talk about where we are in terms of yields. The 2 years at 357, the 10 years at 372. And the long bond's at 407. So long bond up 9 basis points on the week. Month to date, though, 2 years still down 35 basis points, 10-year down 18, and the long bond down 13. So for the week, as you would expect, given that kind of shift higher in longer term interest rates, the ag is down about 10 basis points. Treasuries down 24. Agency mortgage is down about 15. And the winner there from your traditional sectors is the investment grade corporate bonds up 20 basis points. The only positive sector from the traditional sectors. High yield looks like it's up about 3/4 of a point. Bank loans are flat on the week, and EM up 0.5 point. From a month to date perspective, though, the ag still positive 1.7%. We're looking at almost a 5% total return on a year to date basis. Pretty in line. Government's up 1.5 on a month to date. Agency mortgages up 1.7, and investment grade corporates up just over 2%. High yield up 1.5, bank loans up 50 bips, and EM up, looks like 1.75%. So pretty good on a month-to-date basis after this little hiccup here we had this week. Kind of rounding out our main sectors, commodities are up on the week. As you can see, energy, the stocks were up. Commodities also up. Bloomberg Commodity Index up 2%. Finally get a positive week here from commodities. It looks like energy's was up 4%, so that was the big driver there. But all sectors positive. Industrial metals up 1.5, precious metals up 1.6, and livestock up 3%. Looking at WTI crude, it had been bouncing around, had that 60 handle for a long time, Eric, but up about $72 per barrel here today. That's up 5% on the week, up 10% on a month to date or on a year to date basis. And kind of the big winner though, gold at 26.26 right now, up 1.6% on the week and up 5% on the month. So actually looking at gold overall, up 26% on a year-to-date basis. That's on a total return basis there. So overall, good week in commodities, a good week in stocks, and an okay week, I guess, relatively for bonds, still turning in a positive year-to-date performance.
Yeah, it definitely was a gangbusters week in the markets from my point of view.
Yeah, Eric, we did have some, obviously the Fed was on Wednesday, but why don't we get into, why don't you talk about what happened in the macro land before we get into what actually happened on Fed Day?
Yeah, so rich week in terms of macroeconomic data. We started off on Tuesday with the retail sales advance number for August, and month over month came in at positive 0.1%, which was very weak versus the prior, but still better than the estimate. If you strip out auto and gas from that retail sales number, the print was positive 0.2%, a little bit below the estimate, but still positive. And then if you look at the retail sales control group for August, it came in at positive 0.3%. So I would say that the prints were kind of mixed relative to estimates, but they were positive. It wasn't a an incredibly positive report, but it wasn't a negative report either. So the market took a little solace in that. On Tuesday, we also got industrial production. Industrial production came in at positive 0.8% for August on a month over month basis. And it blew the estimate out of the water by a factor of 4. The estimate was zero point 0.2. The prior was also minus zero point 0.9. Now, let's just say before we get into this that some of these beats were helped by some revisions down previously. So, a little bit of movement in the back help these August numbers look shiny. So we got a print of 78% for capacity utilization. That's right in line with the estimate. And manufacturing production came in at positive 0.9%. The estimate was 0.2 and the prior was minus 0.7. And just like for all you prognosticators out there, to have a recession, pretty much every recession in the post, let's say in the post 1970 era in the United States has really seen these numbers deteriorate, the industrial production numbers. The only exception I would say is the 2014 manufacturing recession, where the US didn't see that kind of propagate outwards into the services economy. But just something to keep an eye on. The numbers were positive in this print. So for you recession watchers, nothing here. Wednesday, obviously, the most important thing was the Federal Reserve's decision to decrease the federal funds rate by half a percentage point. And we're going to go into all the details of that in the topic of the week. So I'm not going to belabor that, but it was a little bit of a shock. Not a huge shock. I mean, the Fed had been saying a 50 and a 25 were on the table, but they went on the side of the 50, and the market really ripped. At least the stock market did. Bond market's been kind of mixed, as Mr. Mayberry spoke about, but the stock market really, really loved what the Fed did this week. And on Thursday, we got the initial jobless claims for the week ending September 14th, and they were, I don't want to say they were positive, but they were better than estimates. The estimate was 230,000, the prior was 231,000, and initial claims dropped at 219,000. So that's a beat. And continuing claims for the week ending September 7th also came in below the estimate of 1,850,000. The print was 1,829,000. So positive news there in the labor market. September 19th, we also got the LEI, and the LEI is kind of it's in the junkyard right now, in my opinion, because the print was minus 0.2%. The estimate was minus 0.3%. And I mean, it's still claiming that we're recession, but there's been no recession. And it's been throwing this false signal for the better part of 2 years now. So it's becoming tough to believe the LEI is of predictive value right now. And that kind of wraps up the economics for the week, but there's a lot to discuss with the Fed and the summary of economic projections and all of that. So let's roll into it.
All right, let's get into it, Eric. And as you said, the Fed did cut 50 basis points. That Powell did say in the statement that the decision reflects their growing confidence that with a appropriate, and this is the word of the day, recalibration, of their policy stance. The strength in the labor market can be maintained, and that inflation is moving sustainably down to 2%. So that was the big surprise, Eric. As you said, it was like a 75% chance. The market was pricing a 75% chance of them cutting 50 basis points and 25% chance of them only cutting 25. Our our discussion on the trading desk before the meeting was that probability moved to that 75%-ish level on Friday, and they didn't talk it back, or they didn't walk it back. Nick Timros didn't have a story out on Monday saying that it was going to be 25, or that they were leaning towards 25. So given that opportunity and that kind of market outlook, it seemed like they were going to go 50. At least that was our discussion on the trading desk.
Yeah, you
Um,
nailed that one.
Yeah, though you have to kind of read the tea leaves, and when we went 70, when they hiked 75, that was a Nick Timmerell story that popped on that Monday before the meeting. And so because we didn't get that discussion, it seemed like that was a pretty likely scenario. Obviously, 75% also says it's pretty likely. Chair Powell also said inflation has declined, labor market has cooled, but the upside risks to inflation have diminished and the downside risks to employment have increased, and that's why they're cutting rates. And they say they're attentive to risks to both sides of the dual mandate. It was interesting. The very first question out of the gate. Let me talk about the SEP, the dots first. It really they kind of shifted things down. The unemployment rate went from a 4%. We'll talk about the end of 2024. It went from a 4% projection to a 4.4. So an increase in the unemployment rate. GDP went from 2.1 to 2. They do have inflation coming down from 2.6 to 2.3. That's headline PCE. Core inflation went from 2.8 to 2.6. And then obviously they changed the path of the Fed funds rate. In June, they were expected to be 5. Well, 5.1 is kind of your average, down to 4.4. So a significant decrease. And obviously they cut 50, so that's kind of priced more into the markets now. It's even a decrease in the Fed funds rate. If you kind of look at the longer run, they actually increased the longer run projection of the Fed funds rate. So kind of what people would say is the neutral rate. It went from 2.8 to 2.9. But there's a pretty wide dispersion there. So, everyone likes to look at the median dot because it's hard to grasp all these different numbers and the dispersion around things. So the median dot is something you can kind of point to and Chair Powell said it many, many times in the press conference, that it's not an estimate, it's kind of a projection, a baseline projection of where things would go, but increase that longer term rate slightly. Everything else kind of stayed the same. The inflation they have it on the long term get down to 2%. Unemployment rate over the long run to 4.2, so kind of right where we are now, and GDP from 2% now to a longer run 1.8. So nothing really changed except for the neutral rate increased a little bit, and maybe that's why you're seeing a little bit of a sell-off in longer term treasuries. Also, the fact that I think that the Fed cut 50 really you're pricing in a little bit more higher probability of a recession, Fed being behind the curve when they didn't cut in July, and that cut in 50 kind of made the Fed feel like made the market feel like the Fed wasn't as behind the curve as the market thought. We kind of shift to
I think
the
that
Q&A part. The first question was, are we going to get 25 or 50 in the upcoming months? And that was the question of the day. That was kind of what everyone was wondering. And Chair Powell responded just saying, look at the dots. That's kind of our best projection, our best estimate. But he repeated this many times that they are going to go meeting by meeting. Data, they're going to be data dependent. The risks are balanced. So if you get a higher inflation print, then you would expect that they would be a little bit slower to raise rates. If you get some rising unemployment or rising, or lower non-farm payroll growth, that they would be happier to raise rates more aggressively. They did say they're not in a rush to get this done, so they cut 50 doesn't mean they're just going to continue to cut 50 to get to their kind of 3% long-term projection. And that it's going to depend on how the economy evolves. He did say, we can go quicker if it's appropriate, we can go slower if that's appropriate, and they can pause if that's appropriate. So they're leaving all kind of all options on board, which makes sense given kind of where we are in the economy.
I think though the skeptics out there are like looking at the Fed's SEP and they're like, really, what are you guys think you're doing. In June, you had one cut priced in. Now it's four full cuts, in the SEP. If you look at that 2024 projection. So you went from one in June, 3 months later, now it's four. I mean, so I think, and the market's really pushing for that too. If you look at the kind of futures market, the market's thinking there's going to be three more cuts this year. So they're already fading the Fed, thinking the Fed is maybe, started to give a little ground in the rate area, and the market's pushing for more cuts. So I just think I agree with you that there's definitely been a recalibration from a fear that inflation, they didn't have confidence. That was the word of the month, maybe in the
Yep.
previous meetings. They didn't have confidence that inflation was moving towards their target. But now they're recalibrating. They're not as worried about that, and they're worried about the economy. So maybe I took this as like a kind of a dovish thing by the Fed, where they're definitely admitting that maybe that their rates were just way too tight.
Yeah, and I think you're right, Eric. I guess one thing to keep in mind, though, market was, in December of this year or last year or January, they were pricing in 7 cuts. That obviously didn't, well, I guess I was going to say that didn't pan out, but we still have 2 more meetings, so they could accelerate the rate cuts, and that the 7 could be priced in. But the market's been wrong, the Fed's been wrong, everyone's been wrong on kind of the path, or at least the path of interest rates, what they think they would be. And eventually one of them will be, or the Fed will be right, or the market will be right. But it's kind of hard to gauge. And I think one of the things that, or one of the questions that was asked of Jay Powell, and in his response, he said that if they had gotten the July unemployment report, or the one that comes out the beginning of August, the July numbers, the non-farm payroll and the unemployment number that spiked up, that kind of caused that hiccup in markets in early August. He said if we had gotten that, before the July meeting, would we have cut? And he's like, he said, he didn't say no. He said we might well have. So that just shows kind of how dependent, or how data dependent they are. I think people were afraid that the Fed wasn't going to admit that they were, they should have cut in July, and this kind of, we might have cut, as kind of an admission that maybe they were behind the curve and that they didn't want to be behind the curve, so that's why they cut 50. Also, one of the things people were talking about is kind of interesting. The market, the Fed's pricing in, the Fed and the market's kind of pricing in 200 basis points of cuts to actually have unemployment rise from here. So that's kind of interesting. And is it more waiting for data to give you the kind of signal when it happens? And obviously, Chair Powell doesn't think, or the FOMC doesn't think that they're going to get, they can't price in like a recession. They don't think, they think they're going to get the soft landing, but they think that they need to see a little bit loosening in the labor market conditions to get inflation down to 2, but they're trying to kind of thread the needle and try to get inflation down to 2, because it's still, still a little bit of an elevated level, but without trying to cause the kind of painful increases in unemployment that usually comes with kind of with a recession. So they're threading the needle, and they're kind of long run, or their dots are kind of projecting that they're threading the needle. I think that the fact that they've cut 50 decreases the probability of a recession and increases the probability of them being able to kind of thread that needle.
Yeah, I agree with you that definitely helped them recalibrate away from an inflation fighting mindset to a kind of recession avoidant mindset. But I'm still a bit, I'm still in the kind of skeptics camp that they can really stick the landing here. We'll see what happens, though. I'm hoping they do. That said, I think the probability of a soft landing is far from 100%.
I agree with that. Finally, let's look at, one of the things that we've been talking about is that rise in the unemployment rate we did get in that July unemployment report. And, Chair Powell did say, and he didn't exactly come out and say this, but he said, or didn't exactly come out and confirm what we've been thinking, but he said, if you're having millions of people coming into the labor force and you're only creating 100,000 jobs, you're going to see unemployment go up. And so I think he was kind of dismissing the fact that the Fed was so behind the curve that the labor market is already deteriorated at a place where we're going into a recession for sure. He's still saying that it's the denominator, as we've been talking about in the unemployment rate, was really the big driver of that pop in the unemployment rate. And so maybe, you've had Claudia Sahm out there. She was on TV right before the Fed meeting talking about how maybe that, her so-called rule isn't only works of kind of that labor or the inflows into the labor force are pretty stable and you are countable. So that seems to be the kind of the place of how the Fed is thinking about the unemployment rate. So that as we've been talking about, maybe that's not the greatest indicator to look at. Look at the non-farm payroll number. Look at it in combination. And it was interesting. Also, Chair Powell did bring up the the change in the estimates of the payroll and the negative 818,000 number that I think it was the Census Bureau put out, and how that you kind of mentally discount the payroll numbers now because you know that adjustment is out there. So at least they're in that mindset also. So I think the Fed's in the right place. Or they're thinking about the right things, and they'll be data dependent. They're worried about the growth side of things. That was always the worry kind of going into the Fed cutting cycle, whether the Fed was just going to be obsessively worried about inflation and not worried about growth. But now they kind of have shifted into that more growth mindset, which I think is helpful on a go forward basis.
Yeah, we'll have to wait and see, but I agree. Their mindset has been recalibrated and they're going to be watching like a hawk the data that's coming up. Speaking of
Yep.
data that's coming up,
Perfect.
next week, Monday, September 23rd, we get the S&P Global US Manufacturing PMI. It's the September preliminary, and it's estimated to come at 48.6. The prior was 47.9, still in contraction, but a little bit better. If you look at the S&P Global US Services PMI that's going to drop the same day, the prediction is for 55.3, which is pretty similar to the prior 55.7. And then if you aggregate the S&P Global US Composite PMI is supposed to come in at 54.7, a little bit up from the prior. So we'll have to wait and see, but that's the prediction there. We also get US housing price data. We get the S&P CoreLogic Case-Shiller 20 City print for July, and the estimate is for positive 0.4%. The prior was minus 0.02%. So, pardon me, the prior was positive 0.42%. So the estimate is for very, very similar rates of growth in the U.S. housing market. And if that comes to be, that'll leave the year-over-year number for the 20 city housing index at positive 5.9%. So we'll see, but nothing really a warning sign there. The U.S. housing market has remain strong. Though I will say this week we got some, sales data that, the number of houses turning over in the economy is very, very low. And people are just kind of hanging on to those low rate mortgages unless they really need to move. And then we get the Conference Board consumer confidence data drop on Tuesday as well. The estimates for 103.5. And we get GDP. We get the final estimate for Q2 GDP. The prior was 3.0. The estimate for the revision is down 10 basis points to 2.9, but still soundly in a growth territory. That would be for second quarter GDP, the final revision. Then we Thursday, again, we're going to get the Bureau of Economic Analysis annual revisions to GDP. So maybe something to keep an eye on in the wake of these revisions to the labor market to see if like more of these economic analysis bureaus are doing backward revisions because there's just been some skepticism, like Chair Powell stated, that these numbers might have been fudged in the past. We also get the Bureau of Economic Analysis annual revisions to GDP Thursday, September 26th, and national economic accounts. Now, normally that'd be a nothing burger, but in the wake of some of these revised estimates, particularly the one that Fed Chair Jay Powell discussed in his presser regarding the downward revision to the labor market report, maybe there could be something interesting there to see if there's some revisions down. I don't expect anything, but it could be an interesting thing to watch, which would otherwise be uh, not interesting at all. Thursday, September 26th, we also get durable good orders. The August preliminary number is set to come out. The estimate is minus 2.6%, but remember the prior was a huge, huge number at 9.8%. So normal headline vol there. Drilling down into durables, X transportation, cap good orders, non-defense X air, and cap good shipments. Those are all kind of predicted to be slightly positive. So we'll keep you guys apprised of what happens. Initial jobless claims also comes out on Thursday, and it's kind of splitting the difference between today's print and last week's print. The prediction is for 225,000, so we'll see what happens there. Lastly, Friday, big day where we have personal income and personal spending, which are both predicted to be positive, while the PCE price index comes out. And that's the August print, which is the Fed's preferred measure of inflation. That said, most of the inputs are already known, so we don't expect any real shockers coming in this report. But the year over year print for August is predicted to be 2.3%. And the core PCE for August is predicted to be 2.7%. So kind of in the direction the Fed wants, but still above their 2% inflation target. And that wraps up the economic data coming out next week. Pretty big week. So stay strapped in and keep your eyes peeled.
Yeah, that's a good synopsis, Eric. A lot going on, but maybe nothing. We can kind of take a little bit of a breather there after the Fed and kind of wait and see, take a breather until we get the payroll numbers on, I guess, the first Friday there of the month. But I guess that wraps it up for the week. I'd like to thank everyone for listening out there. Don't forget our website is doubleline.com. YouTube channel is youtube.com/doubleline capital. You have Jeffrey Gunlock and Ken Shinoda's Fed Day reactions up there. I just watched Ken's again this morning, so very good job by Ken, and obviously Jeffrey always does a very good job there. So I'd like to thank everyone for tuning in, and hope everyone has a great weekend.